Trailer Park Traders. Yes, it's me. I've been away for a very long time. I am proud to be back to serve the community and show you some of my findings. I worked diligently throughout the weekend. Actually, I've been working very hard, but especially for the Bitcoin cycle. Yeah. So let's get into it. I just want to start off with the forecast so you don't have to watch the entire video and bore the living crap out of yourself. But essentially, the Bitcoin cycle is this. This is what I'm expecting somewhere between October and the first quarter of next year. I say January, but if I take the actual averages that I came up with throughout all the cycles, then this is the start of the new bull run. Now, I can simplify all this and just tell you prior to every bull run, there has been some sort of loosening from the feds. And a little bit or a little bit after, mostly after, there has been some sort of downturn, approximately 20% or more in the indices. So what that is telling me is that Bitcoin is forward looking. It needs liquidity, a lot of liquidity. So when credit cracks, Bitcoin is already on it. So it starts its downturn first before the rest of the markets crack. So as you can clearly see, Bitcoin is down, and so we just don't have the crack yet. That's what we're waiting for. Is it a pandemic? Is it a nuclear bomb? What is this crack that's supposed to happen in order to crack credit, which is the main driving force of Bitcoin? And let me just show that to you. And to start the cycle repeat again, because once that happens, then the liquidity resets and it's a beautiful thing. So as you can see, chop, 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 chop. So Bitcoin goes up, then comes down 30%, goes up, comes down 30%, goes up, and then starts its final descent in the reset cycle. Here's the start of the new cycle for that last cycle right here. What is this? This is all this is HYG, JNK credit, and it's like an oscillator, not an oscillator, but a stochastic deal here, and here it is clearly. You can see credit goes up, we go that direction, and it happens over and over and over again. I've been watching credit so hard. I was watching the pipes originally, so those who followed me originally, I was talking about the flow of money and liquidity, and when that happens, then great things happen. And I was watching funding and credit, but as I dove deeper into these stress pipes, credit and funding, I started to realize that credit was the ultimate CEO of this whole thing. And then I dove even deeper and realized that the new CEO, same as the last one, is the feds. That's right. When they loosen, good things happen. So let's get back to this before diving too far into credit, as I've already done, and kind of show you the forecasting once again. So sometime between October and the first, I'll just say the first quarter, but January, that should start to be the bottom of this entire thing. Now, that's the actual number forecast based off the averages of the previous 3, 4 cycles that we've had. Okay. With Bitcoin. Okay. And yes, Dogecoin pumps around the same cycles. Altcoin pumps around the same cycles. Now you're going to say, why didn't Doge and Alt have their pump? Well, they did. It just wasn't massive because credit wasn't that great. Okay. The conditions for altcoins to really go to that next level is credit. And Bitcoin isn't an altcoin. So that's why you didn't get the alt pump. That's the problem with not looking at other cause and effects when you're dealing with these trades. And so once you find out that, oh wait, loosening of funds like in 2020, interest rates at zero, right? Legacy liquidity, flooding the market, right? What was it, $34 trillion that just flooded the markets, and a lot of that went to crypto and AI, which they're still seeing their expansion, data centers, etc. But they are starting to top as well. So when you get that environment, then you get that major altcoin rally. But that didn't happen. So we've had a bunch of chop chop, boogie boogie for the credit. And Dogecoin doesn't like that. So we're looking for a major reset in credit before this next thing happens. That's basically the outcome of what I'm seeing right here. We have to have credit crack and a loosening of the Feds, and then we will see a rally again, uh, just like you saw in 2020, depending on how much money they decide to loosen up for us. So uh, let's just take off my forecasting here. Now we're going to start with how did I calculate all this information? Well, it's very, very simple. I really, really love the EMA 1472 or SMA 1472. What am I using? The SMA. It's amazing. The crossovers are a proven, and I know some people use, there's another indicator people use, a stochastic indicator on the 2 week that shows every single rally start. They don't show the finish, but they show the rally start. But I like using the EMA. Some people like using the tops and bottoms, which, by the way, you can't tell trends on tops and bottoms because you'll never know when the tops and bottoms happen. What I am actually looking for is trends. So I did both, by the way. I went well and beyond what I probably should have. So I did my EMA or my SMA crossovers on the weekly 14. I'm using 1472 for my EMAs. So when they cross up, that's the trend indicator on the weekly showing that we have now started. And when they cross down, that's the trend showing that the reset has started. So that the expansion has started when they cross up on the weekly, and when they cross down is showing when it's game over. And I know it's a lagger. It's a huge lagger. So I actually look at the cycle in order to give me more data on where we're at. So the average on the cycles are very, very accurate. So now we can start to put in the average numbers or get the numbers here based off of when the crossover started, when it ended, how long between when it ended and a new expansion started, so on and so forth. And then we can start to compile the averages so we can go on ahead and see what the hell is just going on with all this amazing cycles that Bitcoin does over and over again. And I looked at some people online to see if they had this, and they just didn't dive deep enough in it for my nerdy brain for Bitcoin. So if you found this channel, welcome, welcome. Okay, so moving on. Now we do have the cycle information here, just to kind of give you a macro picture of what's happening. So when that 1472 crosses over on the weekly, you're now in an expansion bull market, which lasts on average for about 961 days. The full cycle overall is 1,350 days, just FYI. Then you hit the peak, and then the distribution stage starts, then the reset, when the crossover actually happens, 1472 down, and then the accumulation period. By the way, we're there now. We just fell below the 200-day moving average on the weekly. And so this is very late stage reset. So stock mode. And like my forecast stated, we're between 100 and 200 days out before this BTC new cycle expansion rally starts again. It could be 300 days, guys. So this is not financial advice. This is just averages and timelines, and they never play out repeatable over and over and over again. There's another guy that's a huge Dogecoin guy that's all he does is look for repeatable patterns on timelines, and I don't think he's ever been right. So yeah, there's always that level of frustration when you go, well, we should be doing it right now. So that's why I have a second layer, EMAs, to confirm trend reversals. Oh, that's why our SMAs. That's why you're using these averages with the Bitcoin cycle on there. So moving on, basic stuff here, guys, basic stuff. So, all right, so Bitcoin weekly 1472 cycle. Let me turn some of this crap off because it's really annoying me. Not bad. Turn that back on. All right. So the we already saw that, Craig. All right. So Bitcoin weekly 1472 cycle. Once again, went nerdy on this. I have the data down in the description, so there you go. But essentially, I took the start to the peak, the start to the reset, peak to peak, peak to reset, reset to start. So I'm using a lot of information here in order to figure this out to get that forecasting data to where we're at right now. So once again, 100 to 200 days out on the forecasting, and then this will simplify. Yes, AI did not do this area right here. I don't know why. I asked it to. I'm like, dude, look, fix it. It won't fix it. So whatever. So here's your cycles. Once again, those SMAs, EMAs, whatever, 1472, that's what I'm using. It's showing those trends. It's showing those trends, those ebb and flows of when money's flowing in and flowing out. Somewhere in the middle of the expansion start to the reset on the 1472 is, you got it, the halving, the halving, the halving, the halving, the halving. So this was a long reset right here. So once again, compiling that data on these crossovers, this is just another look at that same chart that we just saw to kind of figure out what's going on here. Fascinating stuff, guys. I thought it was too. Very nerdy of me. Now, I'm going to get this is the part that I found very interesting. All right, so the yellow and red are the expansion start and finish with the SMAs 1472. Now I'm going to layer on the green and purple, the green representing Fed loosening and the purple representing Fed tightening. Guys, I can't make this any clearer on what the hell's going on here. If you did nothing but sit on your lazy ass and wait for credit to drop, uh, basically all you need in two things for BTC. You don't even need the cycle. You need two things. You need credit to reset, and you'll hear that all day long on the news that, oh, we're in a 20% downturn. That's pretty much an indicator credit is now resetting. But looking at credit and looking at what the Feds are doing. If you did just those two things and bought every single time credit got cracked and the Feds loosened, you would be a multi-trillionaire right now. Quadrillionaire. No, a zillion, quadrillion, zillionaire. I'm being silly, but seriously, that's what this data is telling me. That the CEO of this thing called Bitcoin is well, it's a cycle. Yes, it's a cycle based off of the Fed's loosening or tightening. Because here you can clearly see, oh, we got a lot of loosening, and you get a huge rally. You get tightening, you get a dump. But what about the labor report? What about inflation? What about the tariffs? What about the war? All noise. All noise. Yes, trust me, you will get a 20 to 30% drop on bad data, right? Labor, inflation, oil prices, things of that nature. All noise. The trend is your friend, however, when you're in an expansion for what, 1,300, 1,400 days on average, that trend is not going to stop. Why? Based off the halving and based off of in the liquidity cycle maybe, and I haven't dug into how that operates, but I'm sure something tied with the feds every 4 years is also tied to Bitcoin. Why? Because Bitcoin needs a shitload of liquidity. Dogecoin needs even more, as we found out in the last cycle, and it doesn't like chop chop credit credit. It likes reset credit with a shitload of loosening from the feds. That's the environment altcoins love. The trend is your friend. Start with the trend, and the trend is down. Period. I wouldn't be buying. Oh, it's accumulation. You just said. Well, yeah. Well, look for confirmation because guess what, guys? And I'm going to take this off right here. Let's go back to the forecast and I'll show you how dangerous this is. Just how dangerous this is. You see this line right here? This has been a consistent line with Bitcoin since 2020, your support line. And look what happened in the last reset. You touched it. Well, if that plays out again, you've got about a 50% drop right now from where you're sitting right now. I'm not trying to scare you. Well, kind of. Scare you straight. So 40, let's just say 40% drop to get you into this next forecasting zone right here. So this could come down, literally kiss this at what? $35,000 for a Bitcoin? You heard it first. Trailer park traders. Yeah. By the way, I no longer live in the trailer park. Side note here, I moved back in September. I live in a McMansion now. That's right. My entire patio is the complete size of what my RV was. I lived in a DRV 2008 from Jesus, what 2016 all the way to 2025. So not quite 10 years, 9 years, but I had a great time, saved a lot of money. If you've never done it, I highly recommend it if you're having financial problems. Anyway, uh, so I should change the name of the show to something probably more professional, other than the Trailer Park Traders, but it is what it is. All right, so moving on. I just wanted to point out that potential drop here. Of course, I asked my buddy, and there's no way we could fall that low. Well, I mean, yeah, there is. I mean, this is a major support right here. If we break that, yeah, it's Dumpsville for a while here to this next support line. So it is very, very possible that $35,000 is on the table. And I'm sure somebody's going to play this in the future after all this plays out and go, holy shit, this guy was completely right. Why doesn't he make more videos, right? I'm forecasting my forecast as accurate. Okay. All right, so we're going to turn that off and move on down the road here. I still need that. Okay. So we looked at the Feds tightening and loosening. Green is the loosen, yellow is the start of the expansion, green is the loosen, and purple is the tightening, and how that plays out over and over again. There was loosening actually right here. So technically there was some good things here, but the real start was right here. So this was an actual cycle here. Look how small it was. This was the COVID cycle. Tons and tons of freebies from the feds here. And they started tightening again. Yes, quantitative tightening and quantitative easing plays a huge part of this. When you hear QE, oh, you better move everything. This is not financial advice, but I am going to move everything I can possibly into something in order to make my money, based off of that 900-day cycle to the top. Now, I'm not telling you how to trade this. Everyone has their own, oh, I'll buy here, sell there. I'm just trying to show you the cycles And by the way, really, what I've learned is that if you believe in the cycle setup, then to trade crypto, it's kind of a no-brainer. So I could literally wait for that weekly to cross over, buy it on that SMA 1472, and just turn my back away for 900 days. But I wouldn't do it for the full 900. I would wait till around day 600 to 700 in that cycle period. Then I would trade because you're getting to the market top then, and bad things happen at the market top. But between that crossover to the top, that or 6 to 700 days before the late stage peak, then I would just leave it alone. Why? Well, number one, you're getting 4, 5, 6x your money just by doing that. Okay, in some cases, yeah, I wish it was more. It used to be a shitload more back in the wonderful days of crypto. Now, I mean, I'm talking like 14,000% to 18,000% when we first started this BTC thing. But you don't get those returns anymore. Things are starting to stabilize, unfortunately. So, the most you can hope is between 4 and 6x, depending on where you buy in. So once we get late stage reset, then I'll flip it down to the 2 day, and I'll be looking for the 2 day crossover. And that should give me an extra 1x, 1 to 2x, just by doing that, which is crazy. Everyone has their entry and exit, but once again, the cycle, the trend is your friend. The EMA 1472 is completely accurate on this. All this, it's even lining up to what the Feds are doing, and when things start to slow down, as you can see. Okay, so let's see here. Here are some of the dates now. What are these dates for? Let me turn off some of the noise. More toys, less noise. That's right, Trailer Park Trader. Let me pull this out because I'm not really seeing all this stuff. Okay, turn that off. Turn that off. So here's our tops and bottoms here. So moving on from the Feds, let me turn this off here. So when Bitcoin topped and bottom, basically you could start to put in the averages at that point. And so from the top to the bottom is about 370 days. From the bottom to the top is about 998 days. Well, where are we at right now? We are at, it always does that. I tell you. There we go. So 370 days out is your average from peak top to bottom, just somewhere around October. So that, once again, that number is lining up with the crossovers as well, because when I take the averages from that, it's showing that October is the market bottom. So we should see a reset somewhere around there. That doesn't mean you're going to get the SMA 1472 crossover on the weekly, but you're getting very, very close because that market bottom is there. So should we be hitting that forecasted low, which is down here at that 35? Nobody knows. I can't. Nobody can tell you that data. All I can tell you is what the market cycle is doing. So, and here it is again. I did a lot of work here. A lot of work. I'm just patting myself on the back of all the crap I did. All right. So looking at the Feds again for the tightening, let me get rid of that. Here are the examples I brought in through AI just to see what the tightening and the easing was on all this in the dates. So very, very important when you're trying to forecast these averages. It's just like kind of like if my boss came to me and said, "Yes, I need a forecast." You're not going to take one point of reference. You're going to take a lot of data to try to see that. And here it is again. I don't like this chart as much. It's not showing you what happened back in these areas here. But it's pretty accurate. Basically, if I showed you a bigger macro picture of exactly what's happening, you'll see it clearer. Let me turn this off. Okay, and let me come over here, and we're going to go to my macro view. Okay, now this is pretty important here. So you have uh, your core PCE numbers, your Taylor gap information, exactly where we're at as of today. It updates on its own. I created this through AI. It's pretty cool. Um, your policy liquidity valuation meter. So we're at 3 of 6. Your macro risk, we're neutral, which is playing in line with what credit's doing. Very, very neutral. Very, very chop chop, and you need some sort of break in all this. But the lines here, this is your unemployment line. You see how it just spiked up during COVID and then slowly came down. Well, this is where on that where it started to come down at. Oh, I'm on my macro. I was looking for it in my anyway. This is where the major Fed loosening occurred, your QE, and then as you can see, things started to improve, labor started to come down, and then once we got to around this level, or right around in here, pumps over, boys. It's time to eject from the product and get out, but it's still going. I can't stop. Right? It's the gambler and all of us, so to speak. So, but we don't have those same conditions. Chop, 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 chop. Labor up, down, up, down. Now the yellow is, I believe let me see what the yellow is. The 10-year Treasury, and we have core PCE. So I'm looking at inflation and the 10-year yield. It's an important part here to see the full picture of what's happening. As you can tell, inflation's ticking up a little bit. But what we want ideally is inflation to drop like a rock. Cause and effect, right? Something bad happens. Everybody loses their job. Nobody has money to go buy shit. Inflation drops. Then that gives the central bank, the feds, the power to go on ahead and move that interest rate to zero. It's called the invariant rule. Very important. If you want to be rich, that's what you look at. You roll money into bonds when major problems start. People run for the hills. Unemployment starts to spike. And that's essentially what we're waiting for. TPT is a good ticker symbol. Once that plays out and bonds are like trash, then people and the loosening starts, and then people start rolling and running for the hills from bonds, from safety back over to equities. That's your invariant rule. That's what when I see this chart, that's what I'm looking at. This is how you become a multimillionaire, is understanding cycles. So not only do you have a Bitcoin cycle, you have the invariant rule, which also plays out over and over again. Sometimes there are mini cycles where we only get 20% downturns, and sometimes they're bigger recessionary GDP cycles where you get 3/4 of no growth, kind of like Canada, most of Europe, China, if they would be honest. So that's kind of a macro view of what I'm looking at. Let's jump over to credit because, well, credit may not be the CEO, but they sure as hell are the CFO. And this is kind of giving me just a breakdown of what's happening here. So what I like to do in all this is just simply run this through my AI because I've trained my AI now exactly what to do. And by the way, I wrote not one book but two books. One on UFOs and then one on the pipe system, the flow of money, which I find fascinating. So let me bring down my so I'm bringing down my AI here. And let me see what this all says here. It's thinking. Here we go. So this is exactly the type of environment your new philosophy is designed to keep you out of trouble. Credit phase engine. So from the table, essentially, bring this back down. So it's telling me HYG, JNK, LQD. It's taking these averages. It's running all this through my personal built indicator here and telling me what all this means. So we're getting conflicting information. Credit is widening. Trend slope is deteriorating. Credit is below the smooth average range. You want to see something interesting though. Look how high this is. This is very, very reminiscent of 2017. You have conflicting information, negative, credit is widening, the trend slope, already read that. So the positive momentum is beginning to improve because it's widening. This is exactly what happens near bottoms. I agree 100% with that. So you're getting conflicting information as a result of that bottoming. But it's not permission yet. Once again, we're waiting for the SMA 1472 for the 50th time in this video. The crossover before the trend is your friend changes. That means you now have more buyers and sellers. That's what that tells me. That's all. Does that mean run in and buy as much as you can? Well, it depends on you, right? It depends on your comfort level because you're going to get 30% pullbacks. Guarantee it. It's going to be rough. And that was another part of that because if you've never traded in these type of conditions, you're going to get whipsawed like never before on those bull flags or bear flags. And that's part of the problem. So that's why I'm putting a lot of faith into the cycle. Buy it, forget it, come back, see how much is left or how much I made. So this is the difference between stalking and buying. So even though momentum's improving, anyway, it breaks down all this data for me, so I don't have to do all the thinking and do this. So if I were the TPT philosophy, exactly as you developed it, the CEO decision: wait, no aggressive buying, continue stalking tech, AI, crypto, watch for credit to stop widening. So not only do I have one, I have got two. Let me pull this down. I've got two indicators for credit. I like that one, but I've got three. I'm not gonna lie. I got the spreads too. I want that one. Put this one right here. This is more interesting because it's just more a simplified version. As you can see, this line crossed up. It's the credit is improving. Once that line crosses up, then you start to see expansion zones. So if I just simply take that area right there, and then what is this? The Dow. Let me jump over to Bitcoin. If it will let me. So credit pipe, yeah, way back here. So as you can see, these are like your expansion zones. So credit drives Bitcoin. Cycles drive it as well. So they're kind of synonymous. When you get loosening of the Feds, which then drives credit, which then drives the cycle. And then we can see it on a more macro scale here. Um, so is this the weekly? Yeah, it's the weekly. So it's driving it even further back. So you can start to see how that affects overall credit. I'm moving all the way back here. There we go. Your full expansion cycle, I came all the way back here. And then you can now see, boom, there it is right there on BTC. You got the crossover on credit. Why? Because cause and effect, the Feds loosened, went through a loosening process with QE, and then as a result, in lowered interest rates, and the central banks gave you the legacy liquidity to help you out of whatever problems you were in, and then boom. And once again, this is the weekly, but as you can see, the trend is your friend. It changed right here. And credit was improving right here. I don't know how much simpler to make this. So, but as you can see right here is the downturn. We'll make that red because it's evil and bad. And then we'll compare that to where, oh, look, it's almost exactly where the EMA is on both lines. So credit starts to come down. Bitcoin says holla, shock holla. So an easy way to kind of look at that is what I do on my homemade deal is when these lines start to get smaller, and we've been in the rally for and you do have a crap load of bearish divergence where it's oscillating down versus price was going up. So a lot of tall tale clues of what's happening, especially when it falls right here below this average line right here. You see this green line and the bars fell right there. That's also a huge indicator. But it's green. Green is good. Yeah, but your averages are getting less and less, and it's not going to be. Let me put my coffee down. So apparently I can't do two things at one time. There we go. Yeah, so you can see there was a downtrend and then came back up, bearish divergence, and then boom, crash. So that's your market top right here. Very interesting. Yes, yes. Full of tidbits today on the Trailer Park Trader show. So here are the spreads, and once again, you can see Chop City on the spreads, but improving on the spreads, which is good. Once again, let's go over to Trailer Park, and I this is more of a lagger indicator, so I shouldn't be showing you the spreads, but this credit indicator here is really really accurate. Permission also very very accurate on what it's doing. Once again, a homemade indicator built myself with the help of AI. So when we are in that new trend, that upward trend, that expansion trend we were talking about with 1472, as you can see, once you jump above that moving average, that's your buy, even though it's red. So more aggressive on my entries if I was trading day to day on this on the cycle. But very interesting overall. Yes, I need a Porsche. I'm saving money for a Porsche. As you can tell, credit is actually improving and crypto is doing well. Tech should be improving. So let's go to AI. So as you can see with AI, it's doing very well. Tech should be doing very well. It's mixed, but then when you get to your defensive healthcare, real estate has been doing pretty good. Well, and Johnson and Johnson were two that I was looking at. But Johnson & Johnson's getting some resistance now. That was back here when I was looking at Well and Johnson & Johnson. So um, Staples, here's credit, HYG, J, and K actually are not doing very well. That looks like shit. There it is here. Yeah, credit looks like shit. So high yield bonds are selling off. Risk appetite is weakening. J&K 64 also selling. This confirms HYG. No divergence. Investment grade bonds are also down. Normally, if HYG falls much harder than LQD spreads widen quickly. Today, they're both weak, with HYG holding up only slightly. So typically, when HYG is higher than J and K, that typically means very, very bad. Now, they're both negative, which means even worse. So, yeah, this isn't good. We've got a strong dollar. This is a horrible environment, guys. This is the type of environment where credit sucks, funding sucks. This thing's going to drop like a rock. So it's trying to do a little rally right here, right before, or rotation of money. People who actually have a shitload of money are rotating, your brokerage firms and things of that nature. And they're doing this pre 4th of July. Did any news come out? We want to see fewer job openings without collapsing. We want to see labor go down, guys. Why? Because to sum this up, and I'm going to end this video pretty quickly here. Very, very simple. The economy is doing too good for emergency cuts, and it's doing too bad for risk on assets. Now you're saying, well, wait a minute here. The Dow and the S&P and the Nasdaq are all doing amazing. Well, yeah, the breadth of the entire market is centered around tech. And let me show you what tech's doing. But essentially, what I just said there is the entire market. That's why we want to see, unfortunately, a slowdown in the markets. And so, yes, I know I'm a nerd. I even did all my. Where's tech at? Here it is. So techie. So macro picture, always macro picture. I'm looking trend is your friend. Here's my tech pipe here. And here it is right here. Now, if credit holds and improves, then we're going to be heading in the right general direction. If credit doesn't, because these are growth sectors are dependent on credit. Credit is the CFO. If credit cracks, then defensive stocks come into play. Healthcare, staples, shit like that, utilities. So tech has been coming down and then suddenly a spike. Why? Because credit started to improve, tech started to improve. Same thing with AI. It's crazy how it all works. So, and of course, you're going to ask me what looks pretty amazing. Well, not crypto. Once again, the crypto, and I'm taking averages and a scoring system on my crypto. I'm using this information right here. These are the actual stocks I'm using in the code. It's pretty cool how all this works. And of course, AI actually wrote it for me, but I had to come up and think it all up. But here's the percentages based off the average. So I take those percentages based off the averages. Why isn't it giving me all the code? This can't be all the code. Oh, go over here. Duh. And I pull all these ticker symbols, take the averages, and then run it through an oscillating system. Pretty simple, guys. So if you want to build it yourself, you can. Within 5 minutes, He'll build it. Oh, and I'm also using, yes, that's right. All my oscillators use the 1472. Brilliant. So I'm like across the board 1472 on everything. Some people use the 950, I think, or the this and the that. I've just learned this from somebody else who was using it, and I said, "Well, this has a lot of meaning to it. I can see trends now. I can see growth. I can see expansion. I can see cycles. I can see what I need to see in order to make a more informed decision on trading on my buys and sells. All right, y'all take care. I got to get to work. Hey, it's been nice doing another video today. Like and subscribe. Hope you learned.